Okay, let's do a quick video update. It's Thursday, July 18th at about 8:30 in the morning. What a difference a week makes. So the last update was Wednesday of last week, and the CPI report came out on Thursday morning, and things have changed markedly since then. So up to last Wednesday, this is the Russell 2000. It had risen into the middle of May, and then it started to fall, and it went sideways for much of June. And so all told, from about the end of May to the end of June, early July, it had gone sideways for about 30 trading days. Meanwhile, the S&P 500 was going up, largely on the back of the Nasdaq 100 going higher because the Megacap tech stocks were moving much higher. And so the relative performance between the Nasdaq and the Russell 2000 was enormous. So the Nasdaq trounced the Russell 2000 over that time period. And it was pretty extreme. In past videos and in past weekly newsletters, I talked about some of the statistics that we've seen in terms of the outperformance of the Nasdaq versus the Russell 2000, and it was really in the tails of the distribution. And in some cases, it was outperformance that we had never seen before, so it was outside the historical distribution. But then the CPI report came in last week, and it was cooler than expected. And that seemed to give the market the green light to buy everything else other than Megacap tech. So the argument against everything else before last week's CPI report was that the Fed was on hold, interest rates were high, these stocks are interest rate sensitive, and growth seemed to be slowing. But with last week's CPI report and then this week's retail sales report, we saw that inflation was cooling, but growth, at least with respect to retail sales, was rising. So that makes real GDP higher. If inflation is going down and growth is going up, real GDP increases. And the reaction was pretty violent. The Russell 2000 in a 4-day stretch, I think it gained about 12%, which was one of the highest of all times in that time span. It was about a 4 standard deviation move. If you look at how it outperformed the S&P and the Nasdaq over that time period, those were all-time historical moves in terms of the Russell outperformance. So, the Russell was in this falling broadening wedge, and those tend to be bullish, and this ended up being bullish. Now, coming into the year, I thought that the Russell 2000 and other sectors would outperform tech, given how much tech had outperformed in 2023, given how crowded tech was, and given the lack of crowds in other sectors and in small caps. So from about February onward, that seemed like a reasonable opinion, in the sense that at the April 19th market low, there were 6 of the 9 S&P 500 sectors were outperforming the tech sector. And the Russell 2000 was also slightly outperforming it from, I think, February to April. But then May came along, and NVDA had their earnings, and Megacap tech went wild, and everything else went sideways or down. And so the Nasdaq greatly outperformed the Russell. So this is a chart of the ratio between the Nasdaq 100 and the Russell 2000. Since 2018, it's been in this channel. It hit the top, came down towards the bottom, hit the bottom again here, went up towards the top, pulled back. So I thought, okay, maybe this thing starts moving lower towards the bottom of the channel. Tech's crowded, everything else isn't. Russell 2000 could outperform. It's way below its all-time high. Nasdaq's continually making all-time highs. There's a catch-up trade there. But in May and June, it looked like that was not going to happen, as this ratio busted higher through this channel. But since the CPI report came out, it's crashed back within the channel, and we might be able to look at this as a failed breakout. And the sort of the market intelligence around failed breakouts is that, or breakdowns, is if you have a failed move, they tend to go very violently in the opposite direction, because they have people trapped and off guard, and they're mispositioned, and then everyone scrambling to get on sides causes it to go very violently in the opposite way. And we could be seeing that here. So we had this breakout here, it came back in, it's a false breakout. Now does it start moving towards the lower end of the channel? I think it's reasonable. There's an argument to be made that the Nasdaq 100 has potentially seen its top, whereas there's an argument to be made that everything else is just getting started and hasn't seen their highs yet. If that's the case, everything else will likely outperform the Nasdaq 100. And given the valuations of the Nasdaq 100 and how it's moved over the last 2 years, it's up over 100% from the bottom in 2022 over a 2-year time span. It would make sense for it to kind of relax, go sideways, consolidate, possibly pull back, while everything else is not up nearly as much. And if the Fed is going to cut, if there's the potential for a soft landing, then those stocks could benefit and outperform tech. So I think it's conceivable that we could eventually see this, or I think we will eventually see this ratio move towards the bottom of the channel. Whether it continues directly there now, we'll have to see. I mean, this was a very large move. We might get a little bounce in this ratio, but then I would expect it to start again working its way towards the bottom of the channel. So where does that leave us in terms of relative performance this year? So this is a chart of the S&P 500 sectors plus the equal weighted S&P plus Russell 2000. This purple line at the top is the tech sector, XLK. If you look before last Thursday's CPI report, it was at over 28% on the year. So this is from the beginning of the year. It was up over 28%, whereas this pink line all the way down here was the Russell 2000. It was up 4%. So the tech sector was outperforming the Russell 2000 by 24 percentage points as of the middle of last week. And in 1 week's time, the Russell 2000 is now at 15% for the year, and the tech sector is at 21%. So it closed a 24 percentage point gap to 6 percentage points in the span of a week. That's pretty impressive. And you can see that these sectors here are moving up while tech is moving down. So the performance is starting to become a little bit respectable, a little bit closer. And again, if the rest of the market is just getting started, because there's a lot of pent-up potential upside for them, whereas the Nasdaq may have exceeded its potential upside, overshot, and now has to pull back to a much more realistic value, then we could potentially see these other sectors catch up to tech, in the next few months. So why might the Nasdaq 100, why might it have topped? Well, we showed this last week before the pullback that the Nasdaq was essentially up to its 1.618 Fibonacci extension of the move from the previous all-time high at 16,764 down to the October 2022 low at 10,440. You do a Fibonacci extension on that, it takes you up to 2672, and the high last week was 2690. So it kind of went above that line by 18 points, which is 10 basis points, and then it pulled back. So it was like a clean rejection at that line. There's a lot of room to this trend line. There's a lot of room to this trend line. So it's not out of the question that we may see the Nasdaq 100 pull back, but the broader market, the S&P 500, the Russell 2000, they might continue to go up because there's a rotation going on from the Megacap tech to the other parts of the equity universe. Now, I will say that the Megacap tech has earnings next week. If those earnings come in strong, then hey, maybe this reverses course and goes to new all-time highs. If the earnings are not strong, then yes, I would expect the Nasdaq 100 to struggle, given how much it's rallied so far, if those earnings don't come in as expected. If we look at some of the components of the Megacap tech space, the NVDA looks like it is actually tracking this three peaks in the domed house pretty well. Two things I'm a little wary about with NVIDIA. One, it has earnings at the end of August. If those earnings are good, I would expect this to continue higher. And then also we have that phantom tick for NVIDIA that I spoke about in a previous video at 195.95. So if earnings come in August for NVIDIA, they're bad, and this goes lower, then yes, maybe we've seen the top, maybe this puts in a head and shoulders and goes lower. If the earnings are good, and there's a decent chance they could still be good if the capital expenditures and AI are still strong, then we might see this break even higher, and then I think that phantom ticket 195.95 would be in play. With respect to Apple, we've been tracking this pattern for a while. So from this low here to this high here, it moved 128 points. If you add that 128 to this low here, it takes you to 251, 252. At this week's high earlier this week, it was at 237.23, only 6% away from this target of 251.79. So if Apple hits that target, I don't think this was a fundamental move. This seems more of a technical move, given Apple's not really growing at a high rate. I guess everyone's thinking that now that they're adding AI to their iPhones, people will upgrade all their iPhones en masse. That remains to be seen, but I would expect if it hits that level for it to, that might be the top for Apple if it reaches that level. Given that it's not really the strongest growth, and I don't think people are going to update their iPhones just for the ChatGPT. Here we have Meta. It's in this megaphone pattern. It keeps getting rejected at the upper end of the megaphone. It was just at the upper end 2 weeks ago. It's been rejected pretty strongly since then. That was at like 5:30. It closed yesterday at 461. So that was like a 14% move. Now, if that continues lower, that would be another reason why the Nasdaq 100 may have topped. It has earnings next week. We'll see how it responds. If the earnings are good, maybe it makes another crack at the top of this megaphone. The reason why I don't think the rest of the market is done rallying is because on Wednesday, a Whaley breadth thrust was triggered. So a Whaley breadth thrust is over a 5-day period. If you look at the number of advancing stocks, so you add up the number of advancing stocks over those 5 days and you divide it by the total number of advancing and declining stocks over those 5 days, and if that ratio is greater than, I think, 74%, then a Whaley breadth thrust is triggered. Now, since 1950, there's only been, I think, 14 or 15 that have been triggered. Each one, however, has led to positive returns 12 months forward. And so far it's a perfect indicator. Now, if you look out over 5, 10, 21, 63, 126 days, yes, there's been some pullbacks, but if you look over a year time span, they've all been positive. Although this one right here in 1987, and 12 months later, it was up 1.5%. So not super bullish. This one was up 6.3% in September of 2009. So it doesn't necessarily mean that we're going to go to the moon, but there is a good chance that there's still some rally left. Moreover, the growth now seems to have picked up a little bit. So it started out at 4, it came down here into the mid ones, but now it's up to 2.5 as of 2 days ago. And that was largely on the back of the lower inflation and the higher retail sales. So it's conceivable that, at least from a narrative perspective, the market might think that a soft landing is possible, and that might, along with the breadth thrust, which is indicative of, a lot of people rotating from tech into these other areas of the market, possibly because they think those other areas of the market have more upside potential, given how much upside the Nasdaq has used up or pulled forward. So I do think the rest of the market could continue to rally. If we look at composite equity relative sentiment, it's still solidly bullish. It doesn't look like that's going to change, at least in the next couple weeks. We'll have to see what certain indicators do at the end of the month, but it looks like it could stay in this realm for a while. And the market has tended to perform pretty well when it's up between 60 and 80%. Sharp ratio greater than 1, with an annualized return greater than 20%. When you couple positive momentum with bullish relative sentiment, you also tend to annualize close to 20%, and that's the situation we have right now. So there's really nothing that's flashing any real red signals for the broader market at the moment. It's mainly in the mega cap tech space, and if we look at valuations, and again, this is the broad equity market, and the broad equity market is dominated by the mega cap tech. The aggregate investor allocation to equities is at 0.511. It started the year at 486, so it's risen pretty dramatically as the market has risen, and we're pretty much right at the level that we were at during the everything bubble. We are approaching the level that we were at the dot-com bubble. This isn't the level from which secular bull markets start, it's where they tend to end. Now, coming into the year, I did a video where I said I expected a major market top sometime this year, that the market would rally into at least the middle of the year, but at some point, potentially near the election, it would put in a top, maybe after the election, and start moving lower dramatically and for potentially several years. However, now that that Whaley breath thrust has triggered, and that tends to have a bullish window of 12 months, maybe the market doesn't top this year. Maybe it pushes into 2025. And if you think about sort of the things that are happening politically, it looks like the Democrats seem to be resigned to Trump winning the presidency, and the probability of the Republicans sweeping both the House and the Senate seems to be over 50%. So if you don't want to lose the House and the Senate, you probably want to keep the market elevated at least past the elections. If you want to retake power, if you're a Democrat in 2026 with the midterms, and then retake the presidency in 2028, you probably don't want the market top to have started on Joe Biden's watch. You probably want it to have started on Trump's watch, so Trump has, a bad economic track record, or at least in the minds of people. If they see that their 401k's gone down, the market's gone down, and it happened under Trump, that would be a strong argument for the Democrats in future elections. So if Trump is elected president, he wouldn't take office until late January. So it would make sense, now that I think about it, and now that this Whaley breath thrust has been triggered, it would make sense that the market top would happen after Trump takes office. So it's plausible that any market top that we have, broad market top, perhaps the Nasdaq is already topped, and maybe it goes sideways and down, whereas everything else goes up and lifts the broader market. I don't think the broader market might top now until after the new year, if Trump takes office. If he doesn't take office, if the Democrats end up winning the presidency, maybe it tops a little sooner. So we'll see how that plays out. But the equity risk premium is minus 3.9%. It hasn't been that low since the dot-com bubble burst, and also was that low whenever the dot-com bubble was forming. The expected return on an annualized basis over the next 10 years is about 0.4%. So, we need that to be in the double digits for a secular bull market to start, and we're, light years away from that. So that's all I have. I'll probably put out another video talking about the dollar, gold, oil, long duration bonds, but I wanted to talk about equities in this video. If you have any questions or comments, leave them in the chat, and thanks for watching.